All right. Hello and welcome to the Foundations of Business, Business and Personal Finance, Chapter 18, Financial Accounting, and specifically the first 5 steps of the accounting cycle. Please make sure that you have the guided notes to go along with this as we talk through the 5 steps of the accounting cycle so that you can complete the note guide and turn it in for credit. And we will obviously be going through some of these steps and practice problems in terms of guided practice and independent practice, so that you are fully aware of how to implement and execute these 5 steps of the accounting cycle. So let's go ahead and get started so that we are ready to go next time we meet in class. All right, what we're going to cover in this section or this presentation lecture is the understanding that accounting is essential to understanding a business's finances. It is what is used in order to track finances and indicate health of finances. It is important, and it is called the language of business, as we have covered in previous presentation lectures. In this section, we are specifically going to discuss the accounting system, establishing accounts, the first 5 steps of the accounting cycle, and there is obviously a lot more to this, but we can't cover everything that involves accounting in Foundations of Business. If something like this interests you, obviously we do have Accounting 1 and Accounting 2, which you can move on to from in future years, in future business classes taken. All right, so hopefully by the end of this presentation lecture, you'll understand how to analyze business transactions, how to identify the first 5 steps of the accounting cycle, how to describe the role of the general journal, how to explain the purpose of posting, how to recognize the purpose of a trial balance, and these are the 5 steps. There's obviously, like I said, there's more than that, but this is where we are going to go, and we are going to stop after we get through the first 5. All right. Why is this so important? All businesses must record and summarize their financial transactions. It is the law. And they all do it in the same way, so that it makes sense to all individuals as well as possible investors and other stakeholders. Now, when it comes to the accounting system, all businesses use the same accounting system. It's known as the GAAP, or the Generally Accepted Accounting Principles. GAAP we will be talking about throughout the course of this content. So if you hear me in class refer to the GAAP, that's what I'm talking about. The accounting system is designed to collect, record, and report the financial transactions that affect a business. A financial transaction is any time that money changes hands. There must be a recording and a tracking of that financial activity. All right, financial reports are used as summarizing. They're summaries of the results of the financial transactions and how it affects the business, and it helps then to put into focus what the business's current financial position is. Now, when we do some accounting, we do have some assumptions. So in setting up an accounting system, we must keep 2 assumptions in mind. Number 1, your business will operate as a separate entity. Never mix your own personal expenses or personal finances with your business finances. And number 2, your business makes its financial reports based on an accounting period. Usually it is 1 year or 12 months. It is not always January 1 to December 31. Actually, the most common accounting fiscal year is from July 1 to June 30th. Now, the accounting equation, this is the fundamental equation that accountants will use in order to keep this in balance in order to properly record and analyze the financial status of a particular enterprise. So property is anything of value that you own or control. Property is also considered assets. Owner's equity is the owner's claim to the assets on the business. And then liabilities are the creditor's claim to any of the assets of the business. So we are going to use these 3 pieces in order to evaluate the accounting equation. So the accounting equation is property or assets, which equals the creditors plus the owner's financial claim to any of the assets in the business, also known as assets equals liabilities plus owner's equity. This is the primary equation that accountants will use, and as long as the accountant can keep this equation in balance, chances are this business is in good financial status. An example of the accounting equation, let's take a look. So if our business owns a truck valued at $16,000 and you still owe $3,000 on the loan for the truck, the accounting equation would be that $16,000 equals the $3,000 financial claim that the creditors have on the vehicle and the $13,000 owner's equity or owner claim that they have on the vehicle, which means that $16,000 equals $3,000 plus $13,000. Now, when it comes to establishing accounts, is when the accountant would set up an accounting system. Now, depending upon each business is going to have different accounts based off the type of business that's being conducted. Accounts are created for each of the three categories in the accounting equation: the assets, the liabilities, and the owner's equity. Example being cash in bank as an asset, accounts payable as a liability, and then possibly the individual who owns the business as the owner's equity. Accounts receivable, which are other assets, the capital account, office equipment, delivery equipment, are other assets. This is just an example. Now, other businesses are going to have different assets, liabilities, and owner's equity, but in this case, this is what we have, and this is what the accountant has set up. Now, in order to record transactions and be able to see how they affect the accounting equation, accountants will use what's called T accounts, and they will use a process known as double entry accounting. This is a system of record keeping in which each business transaction affects at least two accounts. An efficient way to apply the double entry accounting system is to use T accounts, and they are nothing more than exactly what they are. They're a big T, and the account title is on top, and the financial impact on that account is recorded in the T. T accounts show the dollar increase or decrease in an account that is caused by a particular transaction. We will practice doing this. Let's take a look. So, for example, this is what a T account might look like. The account name is on the top. The left is always going to be the credit, and the right is always, the left is always going to be the debit, and the right is always going to be the credit. This is the terminology that is used to indicate whether or not the account increases or decreases in value. So you may hear me say, we are going to debit this account for X amount, and we are going to credit this account for X amount to record this particular transaction. The debit is the account entered on the left, and the credit is the amount entered on the right of the T account. The rules of debit and credit. An asset account increases on the debit side, and decreases on the credit side. This is very important for understanding how transactions need to be recorded and the accounting equation remaining equal. Now, if it's a liability, it's just the opposite. Liabilities and actually the owner's equity capital account will increase on the credit side and decrease on the debit side. Let's take a look at the first 5 steps of the accounting cycle. So the first thing the accountant is going to do is collect and verify source documents, how the money changes hands. Some example source documents that may be collected and analyzed are invoices, receipts, and memorandums. After that is done, the accountant will then analyze each transaction and record it into T accounts in order to determine the debits and credits, as well as to determine the change in the value of the account. Then it'll be recorded into a document known as the general journal. This is known as journalizing. This is taking the information from the T accounts and plugging them into the journal. Once it is journalized, then the account transactions are posted to the general ledger. This is how we keep track of the balances of each of our accounts as transactions take place. And then finally, step number 5 is preparing the trial balance, which is used to determine whether or not all of the debits equal all of the credits. And if all of the debits equal all of the credits, then we have a situation where most likely the accounting equation is equal. Now, don't worry about all of this right now. Like I said, we will be going through problems and examples in class to practice this and recording transactions through these first 5 steps of the cycle. All right, let's take a look first at first step. Collecting and verifying source documents. A source document is evidence that a transaction took place and that money has changed hands. Common source documents will include check stubs, invoices, receipts, memorandums. These are used to determine how money has changed hands in order to also determine which accounts are affected by a transaction. Now, when analyzing each transaction, use the following steps. First, identify the 2 accounts that are affected. Then classify each of the accounts, whether or not they're asset, liability, or owner's equity. Decide whether each account is increasing or decreasing, and then apply that properly by indicating if the account should be debited or credited. A sample transaction, let's take a look at this one. On May 5th, Archer Delivery Service purchased a photocopier for $900. Check 104 was written for the full amount. So in order to record this transaction, we want to, and the slide is a little bit off here, but we want to debit office equipment showing an increase of $900, and then we are going to credit cash and bank to make the cash and bank account decrease in $900 because we basically took $900 cash and bought a photocopier. All right, then the transaction, once it is recorded and analyzed, can be recorded in the journal. The journal is a record of all the transactions for a business during a particular accounting period. The process of recording business transactions in the journal is called journalizing. Here's an example of a general journal and that account transaction that we just analyzed. Notice the debit to office equipment for $900, the credit to cash and bank for $900, and check 104, the source document indicated in the journal. After it is journalized, we then take that transaction and we post it to the general ledger. So in this case, we have a ledger account for each of the accounts that we have in the business. This is a book or set of electronic files that contains the accounts used for the business and their ongoing balances as transactions take place. Posting from the general journal to the general ledger is known as posting. So we take what has been recorded in the journal and we post it into the general ledger in order to update the values of those accounts based off the transaction that took place. So notice how we post what had happened in the journal and then we update the balance based off of that action. Office equipment increased in value, cash and bank decreased in value. Here's another example. Here's a better view of it probably on this slide rather than the previous slide, a little bit easier to see. Then in step number 5, we prepare the trial balance. The trial balance is a list of all of the accounts and names that we have in the business, which is located in the ledger. So all of the accounts are listed and their balances. So if they carry a debit side balance, all assets will. If they carry a credit side balance, such as liabilities and owner's equity, the sum of all of our debit side balance accounts or our assets should equal the sum of all of our credit side balance accounts, which is our liabilities and our owner's equity. As you can see in this example, our trial balance does equal, therefore it works out. And this concludes the presentation lecture for the 5 functions of accounting that we will be going over in class. Again, like I said, if this is something that kind of came at you a little bit fast and it's hard for you to be able to grasp just by listening and watching a presentation lecture, we will be doing practice problems, either guided and or independent, to help you get a hang for how this works. So make sure that you have completed the note guide. If you haven't, please go back and revisit any of the slides as needed so that you can turn the note guide in for credit. And I will see you next time we meet in class.